Good morning. Thank you for attending Quant Hub workshop, Collateral Optimization in Light of Credit Risk Regulation and Clearing. My name is Dmitry Pugachevsky. I am Head of Research with Quantify company. This is the leading provider of risk management and credit risk systems. Before joining Quantify 3 years ago, I was head of Counterparty risk modeling with JP Morgan. And before this, I was head of credit quants with Bear Stearns. And before this, I worked for a quant group with Bankers Trust and Deutsche Bank. My total quantitative experience is more than 20 years. So today we are going to talk about collateral and cost of collateral, cost of funding. And I will start with this kind of introduction about recent regulations. As we know, it was stipulated by US regulators, mandatory clearing of interest rate swaps, new swaps, and it was done in 3 stages. March 10th and June 10th last year were deadlines for mandatory clearing for category 1 and 2 swap dealers. And these 2 phases, especially the first, had problems because of unpreparedness of dealers. But the 3rd stage on September 9th for category 3, it's much smaller category, pension plans, investment managers, it passed almost unnoticed. And what's interesting, on this day, volume of clear US denominated interest rate swap reached $265 billion US dollars. At the same time, volume of the bilateral OTC market was just 45 billion. So one can see that volume of clearing back in September was already much more overwhelming than OTC for mandatory trades. There are still unresolved issues, like regarding cross-border controversy on whether non-US clients can operate in US markets without complying with Dodd-Frank. This solution or this solution of this controversy can affect counterparties which are exempt from mandatory clearing under their home rules, like in Europe, but still have to clear when trading with US counterparty where the exemption does not apply. But nevertheless, clearing became a reality. At the same time, are the costs associated with it. And these are cost of funding, initial and variation margins, and also the cost of funding 2% contribution to RWA. We use RWA a lot. These are risk-weighted assets. These are assets which were introduced by Basel I and Basel II. And basically, clearing requires 2% contribution to this risk-weighted asset. Analyzing this cost became a very important tool of collateral optimization. We'll structure today's workshop as following. There will be 4 main parts, 4 main topics. Basics of counterparty risks, Basel CCR, again CCR we will use a lot. This stands for counterparty credit risk. So we will talk about Basel counterparty credit risk capital charges. Then there will the special topic about funding valuation adjustment, and XVA is cross VA. It's basically a combination of all valuation adjustments, including CVA, DVA, FVA. And finally, we'll talk about cost of clearing, but we will kind of build it up slowly because to understand why clearing is necessary and how to quantify this cost, we have to go first through this first 3 parts. And in detail, what is counterparty risk, why we talk about this, what is CVA. CVA, of course, is credit valuation adjustment. This is first valuation adjustment which was discussed by the market and which was quantified by the market. We will look at some sample exposure profiles, try to understand how this CVA is defined and where it comes from. Then how to hedge CVA and how to do this from point of view of CVA desk or from a point of view of regulations. We talk a little bit about counterparty risk engine, what kind of requirements it has to satisfy, And then CVA's cousin, DVA, and their combination, bilateral CVA, will be another topic. And then we talk about modeling collateral or CSA. In the second section, which is dedicated to Basel regulation and CCR capital charges, the plan is to introduce first capital charges related to default risk from Basel II, and then to CVA variants, which were introduced by Basel III. For default capital charges, Basel II requires calculating risk-weighted assets, RWA, and one can use one of three methods, CM, SM, and IMM. We'll talk about them. CVA VAR calculations can be done using standardized or advanced approaches. We discussed them as well. All these are kind of very important for collateral because that's basically calculations. They specify how much collaterals, how much capital you have to set aside against these requirements. Then we will look at some numerical tests, comparison of CVA VAR approaches for a simple case, and then what's the effect of hedging CVA VAR. And then we will look at three real portfolios and compare Basel II and Basel III CCR capital for general scenario, and then we'll look at scenario of market widening, and then collateral optimization strategy of changing maturities of trades. In part 3, which will be, as I said, dedicated to funding valuation adjustment and XVA, we will talk about components of FVA, which are funding cost adjustment and funding benefit adjustment, FCA and FBA. Very interesting JP Morgan FVA report, it was part of their Q4 2013 report made on earnings report made on January 2014. We will analyze it. Then we will talk about wrong way risk, and there are two flavors of wrong way risk: systemic and idiosyncratic risks, and both have kind of different treatment by Basel III. And we will talk about how to calculate wrong way risk in terms of XVA calculation and XVA management. And then very important topic, trade profitability, how to include and combine all this valuation adjustment and regulatory capital charges in analysis of profitability of the new trade. And we'll look at example for interest rate swaps. Finally, we, as I said, build up to the cost of clearing, and we will talk about clearing in the last part of today's workshop. Cost of clearing comes, of course, from initial margin. We will talk about cost of funding initial margin, IMC, that's our suggestion to call them, and VMC, cost of funding variation margins. And we will see that there is actually a very close relationship between VMC and FVA. We will talk about total costs and look at, again, example for interest rate swaps. And we will talk about why OTC trading will continue and why it's important for some corporates, at least, to compare OTC costs and clearing costs and decide how to optimize their collateral. And also we will talk about convergence between OTC and clearing funding costs.